Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to hit the like or the subscribe button on whatever platform you happen to be using. As we begin a new year, we also launch into the first earnings report of the year. So, will companies reflect the gains anticipated by the stock indices? Also, we'll talk about AI and expectations and the impact of the DOJ and possible criminal indictments against the Fed chair and other members of the Fed. It's coming up in this edition of The Bull, the Bear, and You. Welcome to a new year of The Bull, the Bear, and You. And since we haven't met for nearly a month or so, I'll note that all of the major indices had terrific gains for 2025, ranging from 11% for the Russell 2000 to more than 20% for the NASDAQ. And 2026 is starting with a bang, with the indices setting new all-time highs, or at least flirting with a new all-time high. But as time marches on, things happen, companies face new choices, and investor attitudes can change. This week will be the first crucial week for the markets in 2026. This week we get reports on inflation, both at the consumer and the producer level. Also, we'll see how retail sales made out during the holiday season. And the Supreme Court is expected to rule on President Trump's tariffs. And will there be any long-term clouds hanging over the markets because of the threat of criminal action against the Fed chair by the Trump administration? But for right now, one of the most important things we begin with in this round is the earnings season. So let's start with the earnings reports. So Kim, are the companies do you expect going to do as well as the markets reflect, the indices have reflected so far?
Well, I think so. And it's for a couple of big reasons. The first is, as we sit here on January 12th, 2026, it is pre-announcement season. And what do I mean by that? Everything's a season to me. I understand the craziness of that. But this is a time period where if a company has set a goal and has told its investors that it's going to generate X amount of revenue and Y amount of earnings, if it seriously, materially either over or undershot it, they need to report it. It's just the rules. So the pre-announcement season has been really light so far. The other thing that gives me hope is Atlanta GDP now is showing an awesome above 5% GDP growth. So it looks like for the larger companies, probably the wind is at their back because of that GDP in that fourth quarter, but we'll see.
Yeah, it's always an interesting time. As Kim said, pre-announcement season has been very light. So, I think that's a good sign. We talked about at the end of last year, just the practical things we were seeing, like no parking spots at the mall. So I do think that fourth quarter probably turned out to be pretty good. We'll see when the numbers are reported. So that's all great, right? It's a look in the rearview mirror. I'm sure that during this half hour, we'll talk a little bit about what we expect going forward.
Right now, the overwhelming consensus is very positive relative to the markets and earnings into 2026. So much so, it concerns me because I'm not hearing anyone creating a wall of worry for us to climb. And historically, full markets climb walls of worry. And other than me, I don't know anyone that's worried about anything.
Michael, what are your thoughts?
No, it's a good point by Frank. But I think I err on the side of siding with Kim on this one. There's this thing called AI that's kind of just
Right.
came out. I just heard about it, and I am, the more I've been reading, the more I think this AI, we're in the very early stages of it. I think you're going to see companies report a lot of earnings growth in 2026. It's going to see a lot of productivity gains across. The productivity gains might not come as quickly as you think. The job sort of disruption might not happen as quickly as we think, but I still think that is a long-term tailwind for the economy and the stock market as well.
All right, so in my introduction into this particular segment, I mentioned about the inflation reports, retail sales, the Supreme Court decision on tariffs, if they do decide anything this week, or at least announce it, and now also just overnight, really the happenings with the Fed and the subpoena of the Fed chair, maybe some other Fed officials, in a criminal investigation launched by the Department of Justice of the Trump administration. Will any of these things, or could any of these things, have a major impact on the markets? I know it can fluctuate. You can have a big dip at one point, and then everything levels back out again.
I understand that the markets, last I looked, was down this morning, and that's largely why. The independence of the Fed is a critical leg in the stool that holds up the economy, and this action takes that into question. Now, as we have seen over the last year, the mere fact that something was done today doesn't mean it won't be reversed tomorrow. The Congress has been stepping up and saying, slow down, boys, and maybe they will, maybe they won't. We'll have to see. We'll have to wait and see.
I think you're 100% right, Frank. I mean, it would not surprise me that tomorrow Trump comes out, they drop the charges. This is beyond stupid in my mind, what's going on with this. I mean, with the Federal Housing Administration doing this, I don't even understand what they're trying to accomplish with this. But the things you can sort of hopefully have a little bit of insight to or foresight into is the inflation and the tariff stuff. Tariffs getting rolled back, I find it hard to believe that that's not going to be positive for the markets. I think the inflation dynamic in 2026 is the biggest risk for the stock market this year. Inflation, and that's my biggest concern. I think inflation probably remains higher than the Fed or the market perceives. That will cause a steepening in the yield curve. That'll keep longer-term interest rates higher. That will push valuations for equities down lower. That's probably one of the bigger causes for concern on the equity markets that I have in 2026, is that inflation remains persistently high, and that could cause a contraction in valuation multiples for the stock market.
So I actually want to go back to something that Michael said earlier, which is looking at productivity and looking at employment and how AI will impact the two. And that it can happen slowly, which is true, but I actually think we're starting to see it already. We had productivity numbers out last week that were actually better than expected, I believe. And the employment situation is still very stagnant. So those two things are, as Michael pointed out, very important to watch, along with the concern about inflation, because in a dynamic like that, you may actually end up in a period of stagflation. So I know that we're going to talk a little bit more about the employment numbers, but if you do start to see some deterioration in the employment numbers, but yet there are a lot of things driving inflation right now, healthcare being one of them. So, we need to be very careful about that as we look to the economic landscape. In terms of the Fed, I agree it's kind of hard to get your arms around, but the independence of the Fed is critically important because, in my opinion, if we do see GDP numbers that far exceeded the expectations, and we were then to see interest rates come down, that's going to fuel inflation. So that's where we have to really be careful as to how these things play out.
I too want to piggyback off of something Michael said that just was a pebble in the pond, and this is a fresh thought. So I'm going to wheel this out and see if you guys track with me. So I've been spending a lot of time going through LinkedIn, talking to my old coworkers back in tech land, especially those who, were in AI or are in AI. And they're seeing the same things I am, that the current large language models are just fraught with errors, all of this. Now, here's a theory. When we came out of COVID, we had all these people that nobody wanted to let go of, right? And so that was kind of dragging productivity lower because, it's hours worked, right? That's kind of one of the metrics. So we've seen companies right sizing, but we also see people that are really afraid of getting replaced by AI. And maybe, just maybe, coming out of COVID, where, work at home and maybe we weren't our best selves at work. We'll just say it that way. Maybe people are trying harder, and the bump we've seen in productivity is a reaction to what might happen in the future. But, we'll have to watch. I mean, we all watch productivity closely. Let's just not kid ourselves. But I really am not seeing anything. And the people that I know that are working in it aren't seeing the gains that regular investors are looking for, that they think is just around the corner. And I think everybody on this call thinks, or everybody on this show thinks it's going to take longer, but it will come, right? But the future isn't here right now for productive AI use, wholesale productive AI use.
Yeah, it's interesting this morning. There was an announcement with, I won't name names, companies, but 2 companies, one pharmaceutical, one technology, that are teaming up, investing $1 billion into AI and how that can transform healthcare, which is true. And we know this. It's interesting, the lag time, having been involved very closely here in Pittsburgh with the medical research community. And what's fascinating about medical research is that these scientists do research and then it sits on a shelf. And unless someone's willing to put money behind it, it never really makes it out to, the bedside, so to speak. So we know, and there's research that was done here at the University of Pittsburgh years ago to show how, I don't think we called it artificial intelligence back then, it was just computing. How there was an example of a leukemia patient that when they ran, I guess, the type of cancer they had through their computing models, it came back to show that a glaucoma medication could potentially actually cure this or put it into remission, which then, they did. And now we're starting to see, that's very exciting to me, right? That if you start to get the investment into that, how it can actually impact people's lives, there's a whole nother, Pandora's box to open about how much it would cost. You create a drug, right, that could cure something. Are you going to be able to afford it, or will the insurance companies allow it? But I'll just table that. That's a whole nother discussion. But, we are starting to see, see how things can really have impact.
110 or 20 years ago when we started with the car business, people would buy cars and then they would pile, if they had to go any distance, they would put several spare tires in the back of their vehicle because they would blow out all the time because the tire technology wasn't there. And this is akin to that. Today, the accuracy component is not there. It will be. Mm-hmm. Smart people like Kim are working on this, and they will come up with a way to vet the information, and the user will come up with ways to vet the information. A lot of the users will use their own databases rather than the internet database, if you will, to make their businesses better. So to me, AI is unquestionably a gorilla waiting to grow up. And it will grow up eventually. But right now, in my mind, it's a big deal in the future. Not today, though.
Well, this just totally segues in with the next subject I wanted to get into, and that was back in December, I questioned you about whether the markets, and therefore the stocks tied to AI, whether the investors felt that this could just be a whim as such. Whether the love affair with AI was going to wane. If the Russell 2000's surge in the last part of the year and early part of this year is any indication, the answer may be that it is beginning to wane. So, in your estimations, where do we stand with tech stocks and AI, and What about the other sectors that have seemingly come on strong now in the last part of 2025 and early 2026?
Well, I would say that, with all the excitement, and we're talking about the value of AI and that it's here to stay and that it's going to revolutionize many things that we do, you still have the reality of the stock market, which is there are valuations and there are earnings. And so even the example I brought up earlier about $1 billion investment, where's the return on that investment? How far out do we have to go in order to see a return on that investment? And what I'll tell you is that I wish it were that easy. I wish it were just like, oh, this stock's overvalued, let's sell it. But the thing that causes valuations to come back into line are usually things no one's talking about. So I'll give you an example that we are concerned about, have been concerned about, is that there's a lot of volatility with Bitcoin. Well, a lot of investors that own Bitcoin are highly leveraged. Well, if we see some collapse in the Bitcoin market for whatever reason, does that then mean that there are going to be capital calls on these margin accounts, and then you're going to have to, you're going to have forced selling in the market? You look at the major crises that we've had historically, and you had COVID, you had the financial crisis, which was all about the shadow banking system, which most people weren't even aware of. You have 9/11, you have in the 90s, the collapse of foreign currencies. What we want to be doing is searching for the things that no one's talking about, those little headlines that come across. As they say, the things you're reading about, you generally don't get hit by the bus you're watching. So, so valuations matter from that perspective, because it's more, it's like standing on the roof instead of standing on the porch, right? When it comes down, it's going to hurt a lot more.
I think Carrie's right. As it pertains to AI, there's a good price to pay for anything, right? While I'm very bullish on those companies, the Googles, the Apples, the Amazons of the world, there's still a good price to pay for them. There's not a good price to pay them. Just like there's a good price to pay for a utility company. So now you're starting to see, Stacy, in your question, like the Russell 2000 broadening out, you're seeing a broadening out now of earnings growth amongst other companies outside of the Mag 7 or the AI 30, right? The top 30 stocks, AI stocks in the market. And so that leads me to believe that 2026 could be a year where you get broader performance in the markets, not only in the U.S., but certainly overseas as well. We actually think the overseas markets, the outperformance you saw last year can continue into 2026 as well. So I think diversifying out of some of those AI plays, while those are really, really good companies, the expectations, as Carrie pointed out, are incredibly lofty. And we saw that with NVIDIA a couple quarters ago, where they had record revenue, record earnings, and the stock still dropped 4% the next day, simply because those expectations are incredibly, incredibly high. And once you don't meet those, you're going to see a pullback in the stock market. But the good news is you're starting to see a broadening out of earnings growth across sectors in the U.S. and overseas. So I think it's going to be a more healthy market for investors in 2026.
2024 was a really unhealthy market because one stock drove the market for 3/4 of the year, and then miraculously 6 other stocks joined it. I mean, it was the goofiest. Nobody else won. I mean, that was just it. So I agree with you, Michael, that things are broadening out. What I don't really understand is why people are looking at the Googles, the Microsoft, and the even Amazon to a lesser extent, and saying that they will plow all of their money forever and ever into AI. And they have boards of directors. Well, maybe not Google, because it's really the 2 guys that started it. That is the board, that they really report to, because they have voting power, special shares. But everybody else has to kind of make this work as a business. And I think that's really kind of up in the air, given how much money that currently the models that they're using need to be, how much they cost to be created. So that's thing one. But I am very happy to see that investors that were just solely focused on NVIDIA have broadened their scope. And that is just really, really encouraging that people are looking for growth elsewhere. And I'm very encouraged.
I have nothing to add to this.
I'm going to write that down. January the 12th, 2026.
It's interesting that Kim
Send
said
that to my
about.
wife, but she won't believe it either.
Yeah. Go ahead,
just,
Michael.
just one point on Kim's comment and the boards and all that kind of stuff. I mean, Sergey Brin, who is, as Kim pointed to, was one of the founders of Google. I mean, I think he said something like last year that he would rather bankrupt his company than lose this race in AI. So they are.
I mean, the thing is, right now, large language models are replacing Google. So he has to. I mean,
right.
That's it. But the other
investment- I
people,
think
Meta, you know, I still don't get what they were chasing. Well, they're called Meta because they were going to make the metaverse where we were all going to live, which I thought was creepy and horrible. Just from, I try not to be in front of screens when I don't have to be. So living through the screen was just not going to happen with me. I don't care if everybody else was doing it. But yeah, I mean, I think for a large amount of other companies other than Google, who its very existence could be wiped out by people going to, you know, the next language model that's working. Luckily, it's theirs right now, right? But so that's what you have to have that perspective on, about Google in particular. But the other companies, you know, they're going to reach a point where the board says no more. You know, you have to pull back. So we'll see what happens then.
Kim, have you ever been to the metaverse?
No. The goggles make me
Yeah.
sick.
Yeah, it's
I
very
get
creepy.
car sick. Yeah.
I will tell you, I mean, it's, we did a test once here. Someone in our office has an Oculus. We have an Oculus. And we met in the metaverse.
Yes.
And you have your own avatars. And she kept talking to strangers, which made me really uncomfortable. So uncomfortable that I changed my avatar from a female to a male because I just like was so creepy. And it's like, it's real.
Yeah.
So anyway, yeah, it's I don't
When
know.
you said she was talking to strangers, were these something that's created, or they were really strangers?
Well, you know, everyone goes into the metaverse, so you know, log in, and in this particular case, there were movie theater. There was like a comedy show you could go watch. You could watch a Sixers game. So there are different things that you can do. And someone was looking for the Sixers game. So they came up to us, their little avatar, and they said, hey, do you know how I get into the Sixers game? And of course, she was like, absolutely, like, I'll show you. And I'm like, don't talk to strangers. It's just very creepy. But, you know, literally, like we went into this comedy show and it's a video. You know, the quality's not amazing, but surprisingly, yeah, it's definitely interesting. I had to get one. Like we got one for our kids, but then I became obsessed with it. So then for one of my birthdays, I got one. So now I have my own. You know, there are different games, and you can do a variety of different. Anyway, you can do yoga. You can meditate. Like it's not just all creepy.
Okay.
Go ahead, Mike, what are you thinking? You got that patronizing look on your face.
No, not at all. Not at all.
So here's what I think is so interesting. We would never have guessed Carrie would be the metaverse girl. 0% chance of that. And yet here we are.
I'm surprised a lot of people. Like I can actually bake too. I know that's might be a
I could see
surprise.
that.
All right, well, let's move on here before we run out of total
Sorry to
time.
derail.
We'll go back to this universe and not the metaverse. The president has made some moves regarding oil, and he's urging a cap on credit card interest rates, at least for a year. And as an investor, if I happen to own energy-related stocks or maybe some of the financial stocks, should I be concerned? Should I do anything at this point?
Well, the market's taking care of it for you. The credit card companies are getting shellacked as we speak. And the reason is a lot of their profits come from people that they're charging more than 10% to. And their spreads are enormous on that. So if this actually happens, the ability for lower quality credits to borrow money through a credit card is going to go down, because at 10%, that's not enough spread for the credit card company to pick up for the default ratio that undoubtedly they have in credit cards. So they have to start actually lending money to people who can afford to pay it back and be less concerned about being more, I don't want to say democratic, more universal in who they give credit cards to. This will not be good for retail sales. This will not be good for a lot of things. And the facts are most people still do pay those back.
Yeah.
I agree. It's a horrible move to force companies to do things. I am very much a capitalist, but along with that, there are rules that we have to have. Absolutely, not saying that it should be just, market setting prices on, well, setting behaviors. We'll say that, but whenever a fair amount of rules are there to make sure that nothing egregious can happen, you have to let pricing play out. And a 10% or forcing somebody to 10% for credit card limit, that's goofy. And forcing companies to go into an area that they may or may not have expertise in. We're getting to that point. That's a very different oil field than many places. It's just not what the government should do. So let the money-making part of the economy go, or of the world go, and the government should make rules, but not like, here you go, this is the business you're now in. That's terrible.
Yeah.
Look what they did for Intel. They gave Intel some money. They made them a favored company, and the stock went from 30-something to 50-something. All right, because they decided that was a favored company. This is not capitalism. Capitalism is survival of the fittest. Run your company. There's certain industries they bail out because they're important from employment points of view, but universally that should not happen.
This is plainly said a geopolitical event, and we've talked about it ad nauseum on the show. You can't invest based on geopolitical news or events. It's too hard, especially, again, I don't care where you are from on a political standpoint. With this administration, I think anybody, Republican, Democrat, would agree, it's very hard to make investment decisions based on what's going on in Washington. So anything can get reversed, anything can change on quickly. So, Stacey, to your question, would I invest or pull my money out? No. I mean, I would just try to find the companies that you like, solid long-term investment plans with them, and invest based on that. You cannot do it based on geopolitical movements in Washington, D.C.
Yeah.
Or anywhere else.
Yeah.
True.
And, the credit card idea, it just, again, we're talking about further perpetuating inflation. It's just not the right thing to do on so many levels. It encourages more borrowing by consumers, and, it doesn't really get anyone ahead.
All right, one final quick topic here, because Carrie, you touched on it before, and that's the latest unemployment numbers or employment numbers. It seems like it's become stagnant right now. A lot of people who are out of work can't find a job.
Mm-hmm.
Is this of concern to any of you?
Yeah, I mean, the participation rate has declined, which is really important when you sift through the numbers. So, again, this kind of goes back to the earlier conversation too about AI, and is it already having impact in terms of the employment situation. So, it's definitely something to continue to monitor, because as investors, we're aligning portfolios with how we feel the economy is going to perform from a price perspective and a productivity perspective. So, it's one thing if you have a healthy amount of inflation, but your employment situation is good, versus having a situation of stagflation, which is what, as we look to 2026, we're really watching those data points, because that's a situation that's challenging for investors.
All right. Oh, go ahead.
Nope, good.
You sure? I don't want to be the one who ever silenced you, Michael. So. Well, we will continue our look at investing in the economy in future editions. Also, since you're watching or listening to this podcast, I urge you to hit the like or the subscribe button on whatever platform you happen to be using. But for right now, thanks for joining us, and we'll see you again for the next edition of The Bull, the Bear, and You.